Hey guys, Stockaholics, thank you guys for being here today. I wanted to make a video talking a little bit about oil today. I know there's been a lot of sentiment shifts, a lot of volatility in the oil markets, particularly over the last couple of weeks. But I wanted to talk a little bit about why I'm still bullish on oil, despite oil getting to some reasonably high prices up there. So in this video, I'm going to talk about why I'm bullish on oil. I'm going to talk a little bit about capex cycles in the oil industry, look at a little bit of some of the history of those. I'm going to talk about some of the behaviors that a lot of oil bulls are talking about that they're noticing in the industry. And then I wanted to point out my favorite oil company and how I am playing the oil market. Over the last year, I've been pretty vocal about bearishness on several commodities, I would say. And I guess the trend that we've noticed in a lot of these, particularly when I'm talking about metals, recently when I've been talking about coal and some other ones, is that their prices have gone absolutely vertical. Now, if you listen to a lot of mainstream news outlets and things like that, you'll have all of these wonderful guests come on and they've been pointing to this as proof of the commodities super cycle. I think a lot of those narratives have been dying down lately as those prices have kind of been reverting to normal prices. The real reason a lot of these commodities have just shot up in price is not because there is a commodity super cycle, but rather it's been this weird situation that has arisen from unprecedented, unexpected demand in a lot of these, particularly from Western countries and stimulus and goods spending instead of service spending. And at the same time, supply chain bottlenecks where there's lockdowns, there's shipping issues, getting these things across the ocean. And then there's also what I think that we're in the final stages of now, these bullwhip effects where just too much inventory is being built up and using a lot of these commodities to kind of try and match demand, right? Now, this is why I've been bearish on a lot of commodities because I just think that this isn't what you would typically see in a super cycle. The super cycles are usually characterized of sustained high level demand, and the big difference here is that this is not from healthy economies; it's from government spending and lockdowns and whatnot. Right now, oil has had the complete opposite story of most commodities. And that's actually probably why I've been so bullish about oil. Last year, when the lockdowns started, oil got slammed. The Russia and the Saudis and OPEC got into a spat. They put way too much oil on the market, and at the same time, there was unprecedented demand destruction. It's only now, about a year and a half later, that we're finally reaching 2019 levels of oil demand, right? So what this caused is huge problems in the oil industry, and in cyclicals, these problems can be really good. It causes a lot of bankruptcy, it causes a lot of underinvestment in an industry, and over time, demand for this commodity, like all other commodities, returns to normal and goes up. And so last year, at the same time when those oil prices went really, really low, you saw these really pervasive narratives all over the place, basically extolling the death of oil. This is more proof of the electric revolution and all of those things. Just like you saw on the opposite side when all the commodities were going vertical, everybody was talking about a super cycle, right? So both of these narratives, they become the most prolific when you see prices matching what people expect them the reasons for those to be, and those are completely divorced from a lot of the fundamentals, right? Now, I stole this from a YouTuber called The Oil Investor. He only made a few videos and he stopped making them. Uh, I would like you guys if to go into his channel and tell him to come back if you like his videos. I'll put a link somewhere below talking about him. They're really incredible videos, and I really like the way that he talks about the cyclicality in the industry. And it's not something that you really hear a lot of people talk about. And really, this is what drives oil prices and thus profitability. And that is investment spending. Because it's an extractive industry. Over time, when these guys go out and invest into oil fields, those investments lead to production, right? So if you have very high capex spending, like this chart may show you at several points, that usually leads to periods when then there's going to be too much oil, and price will go down. Likewise, when you see very low capex spending, tends to lead to these periods when oil prices will go up for sustained periods of time, right? And anytime you see that the capex spending in these cycles goes very low, you usually see them followed by several years when the oil price has sustained highs. And one of the things you'll notice is that from about 2017 to about 2020, the amount of capex in a lot of these oil majors has been really low. So there's probably been significant underinvestment in oil production. And what happens when there's not enough oil production? It's likely that, again, those oil prices will have sustained periods of time when oil prices go high. And so this is what I really like about oil, is because not only have we gone through this period where oil, there's probably been underinvestment, but in addition to that, they got absolutely wrecked in 2020. Now, we've talked a little bit about long-term supply and the fact that there's been very low capex spending, at least for the last couple of years. But the other side of the equation is demand, right? So for there to be a high price, you need very high demand. And over the last couple of years, what we've seen is that there's been very low demand. Not unexpected because of all of the situations that have arisen because of the pandemic, right? So this is from the EIA, and it's taken from a couple of days ago. And I'll just read this. We estimate that 99.7 million barrels per day of petroleum and liquid fuels was consumed globally in November, a approximately 5 million barrels per day increase from November 2020, but a 1.1 million barrels per day less than November 2019. So recently they've revised down their forecast of consumption of petroleum and liquid fuels for 4Q21 and 1Q 2022, partly as a result of recently announced travel restrictions following reported outbreaks of the Omicron variant. So there's been a lot of speculation about this variant, another one of the Cerveza, and based on a lot of the things I've been reading and seeing out there, it seems to be that the reactions to this have been largely overblown. The symptoms compared to the last couple of variants are very mild, but I'm not a virologist, so we'll just have to wait and see on that. So my question that I would pose to this is this, and that's, what happens if air travel rebounds higher than people anticipate, right? So right now, we're at approximately the same level of oil demand that we were in 2019, despite there being a 1 or 2 million barrels per day shortage in jet fuel consumption, right? So what happens if and when this thing ends and the air travel rebounds, right? What happens if you get 2 million barrels per day increase in demand, and that demand is sharp? I think that there's a very strong possibility, again, that you see high oil prices for longer. This is an article from a gentleman called Doomberg. There's not enough oil. Though it might not appear like it's the most professional of sources, I think it's a great article, and I think it summarizes a lot of the bullish reasons a lot of the oil investors are out there investing right now. So I wanted to kind of go down here and share some of these things, right? So the shale boom, which has kind of characterized why oil prices have kind of stayed in this lower range over the last several years prior to COVID, we've seen some changes taking place in that. So the shale boom enabled the U.S. to reestablish itself as the top global producer of oil and gas. Prior to the COVID-19 lockdowns, the U.S. was producing approximately 13 million barrels of oil per day, more than double what it had been generating just a decade earlier. So we went from a net importer of oil to actually in the United States to a net exporter. To put that number into context, the world consumed an average of just under 100 million barrels per day in 2019, pre-COVID. For 2020, that number dropped to 91 million barrels per day. Huge destruction in the industry. But some estimates peg current global demand to have fully recovered to the 100 million barrels per day mark in Q4 2021. Interestingly, U.S. oil and gas production is still lagging its 2020 peak, which you guys can see here. So in 2019, they were somewhere up here in terms of crude oil production, and despite there being a huge rally in oil prices higher to that of which was taking place in 2019, we still have not seen that crude oil production recover, right? While many assume the gap in current production from the pre-COVID highs represents spare production capacity that can readily respond to incremental oil demand once the global economy fully reopens, the reality on the ground is different. As Johnson flags, producers are busily completing previously drilled wells at a rapid pace without backfilling the inventory of DUCs. In effect, U.S. shale oil producers are sluicing previously stripped ground and not opening enough new cuts. This is clearly unsustainable. And so he goes on here to describe why this might be happening. So we've seen them, they haven't been drilling, or they've not been creating new wells at the same rate they have before. So what explains this behavior? We see a combination of factors. First, shale operators destroyed significant shareholder value through excess drilling and mismanagement during the boom. Many companies filed for bankruptcy protection shortly after the COVID-19 lockdowns were implemented and the price of oil collapsed. The recapitalized companies that emerged from reorganization are expressing a commitment to a more disciplined approach, an approach that I would caution that people should continue to watch. And the numbers certainly reflect this. Second, the Biden administration has signaled its desire to move beyond fossil fuels, which, at a minimum, makes the investor environment for new exploration and drilling more uncertain than it was under Trump. Makes it hard to go out and drill new wells if you're not sure what kind of signals you're going to get from political sources, right? Third, the move to defund the fossil fuel industry by environmental activists and Wall Street financiers alike is making access to capital more challenging. Banks have these ESG requirements now, and they're more hesitant to loan to a lot of these oil producers out there, especially when they've seen in the past 5 or so years they've been just burning money, right? Finally, uncertain timing. And I think this is probably the most important of all of these factors, at least where we are now. The world's emergence from both the pandemic and the ongoing supply chain crisis is likely adding to the cautionary stance. So if you're an oil producer and you're like, well, I don't know what's going to happen. These guys keep talking about new lockdowns, new variants and stuff. Do I really want to go out there and produce some new wells out there when we just saw a year ago how wrecked you can get if you go and do that? So there's a lot of caution in the space. And what this is leading to, again, is, in my opinion, and many other people's, that there's probably an underinvestment in the space. Now, even though the United States has become a huge player in the oil game, especially over the last couple of years, there's some strange behaviors we see from OPEC too. Surely the members of the Organization of Petroleum Exporting Countries, their cooperative of non-members, including Russia, have more than enough excess pumping capacity to make up for the anemic performance of U.S. shale? Perhaps not. For insight into that all-important question, they have turned to this guy, Josh Young, CIO of Bison Interests, an investment fund focused on oil and gas public equities, who has been sounding the alarm on the potential true nature of the spare capacity of OPEC+. You can read that there. And again, I'm going to put a link somewhere below if you guys are interested in any of this. As energy prices across the globe rise, many observers and pundits continue to downplay the possibility of a global energy supply crisis, often citing OPEC plus spare capacity as the panacea. The perception that OPEC Plus is flush with spare capacity is pervasive, but due to a lack of reliable data and no formal ongoing reporting or verification requirements, many experts and analytics firms have adopted OPEC Plus's self-reported numbers. No one knows exactly how much spare capacity OPEC Plus really has, and not that many people, a few, seem interested, despite the potential implications. After performing a bottom-up analysis of several key OPEC Plus producers with a more realistic lens, he closes with a sobering assessment. With likely 2 million barrels per day less spare capacity than claimed and widely believed, the oil market is much tighter than believed. As world oil demand recovers post-COVID-19 and it grows to new highs, there may be a call on OPEC Plus spare capacity, particularly as inventories deplete. And if you look at inventories, we are well below 5-year ranges as it stands now. We may be approaching a time of higher world oil demand than world oil supply capacity. Others are equally skeptical of the true nature of OPEC Plus's spare capacity. Take this gentleman, and Alexander Stahil, an excellent Twitter account we follow closely, who has posted several provocative threads on the topic. The oil market is a tight come Q4 2022 with less than 3 million barrels per day OPEC spare, if not well below that. So the question becomes, right, if there's only a very small margin of spare capacity that can meet demand, if that demand is there, what happens if there's disruptions in the oil global supply chain, much like the disruptions we've already seen in the last couple of years? What happens if there's an issue in the Middle East or something like that, right? And another thing that you notice in a lot of these OPEC producers is that they've already not been making their quotas in several cases. So if you have the ability to produce that oil and those oil prices are very high, why is it that you would not make that quota, right? Why would you produce less than you're allotted in the OPEC plus cartel, right? So there's a lot of strange things taking place, and there's a lot of evidence that suggests that just like we've seen in some other cases in the United States, there might not be enough production there to sustain demand in the coming years. Recently, I was on a live stream with Scott from Scott's Stock Due Diligence. Great channel. Go check him out if you haven't. He's got very awesome DCF valuations for all kinds of companies, and he does some high-level breakdowns for those companies. So it's great for a baseline of research if you're first investigating a company. I like it a lot. But I was on there, and people in the chat were asking me, "Hey, what do you think about XYZ oil sands company or XYZ ocean deep water oil producer?" And it's like some companies that I've never heard of before, right? And I guess the only way that I could respond to that is to say, well, I guess it would depend on your risk tolerance, and I guess it would depend on what you're trying to achieve. If oil prices go very high and you're invested in one of these companies that are very high on the cost curve, the share price appreciation you will get in these companies will go up dramatically, right? Because their earnings per share increases massively the further you are out the risk or the cost curve, right? On the flip side, if you choose to invest in one of these companies that are lower on the cost curve, there's less risk because let's say that despite all of this narrative, we're completely wrong, and that doesn't materialize, or there's a global recession or whatever, then these producers that are lower on the cost curve, if prices go up or way down, you will see less upward movement or less downward movement. But for me, I always like to go when I'm thinking of cyclicals, and this is just me, I like to go as low out the cost curve as I can. It's because these producers have a competitive advantage, and what you notice a lot in the oil space is what these guys do is they tend to produce very high dividends. So even if I get this whole narrative wrong, much like those guys who went on CNBC and said there's going to be a super cycle, right? I could be that guy who's wrong talking about all of this oil stuff too, right? I don't spend my full time in the oil game, you know? So if I'm wrong, I like these producers because even if I'm wrong, they're still going to be out competing their competition, and they still have pricing power, right? And they have higher ROE, higher ROA, and all of that stuff. And they pay dividends. So for me to sit here and wait with one of these guys is a lot better for me and my style in this space of investing. And that leads me to talk briefly about my favorite oil company, and that is Lukoil. Yes, they're an oil major. I think they account for roughly 2% of global oil production. They're not the lowest on the cost curve of producers, but they are still very low on that cost curve, right? Now, what I like about this company is what this article mentions down here. I'll put a link somewhere to that below. Lukoil combines favorable tailwinds, some of the tailwinds I think that we've discussed, and dividends. This is why I like this company a lot. And value. It's cheap relative to all of these things. Now, you might argue, okay, well, it's cheap because it's a Russian company. Well, I'll leave that to a lot of you guys to decide, right? So this stock pays to wait. The Fortress balance sheet isn't only good for acquisitions. They've got a lot of cash. They've got low debt. The company is very generous with its rich cash flows. Lukoil's dividend yield for this fiscal year is 9%. And from the prices when I've been buying this, if I want to account my baseline, that dividend yield is a lot higher. So it's, for me, it's just, I'm just getting paid to sit around and do nothing with an incredible company at very high dividend yields, right? This is an excellent return considering that Lukoil's cash flow bear little currency risk as they're highly tied to oil prices. So what that means is a lot of their business is denominated in dollars and a lot of their costs are denominated in rubles. So with ruble devaluation, which has been the trend for a long time, their costs tend to go down and down and down. And then with dollars, which we've seen recently have been going up, they're getting paid in higher value dollars, right? So however, it gets even better with consensus expecting 11% dividend yields for the next few years. So let's say that we're right and that a lot of these things that I mentioned are true. You'll expect to see higher profitability in this company, therefore higher dividends, and at the same time higher share prices, right? Okay, for the next few years. And 11% yields means that this investment will pay for itself just in dividends in 9 years. So if I'm completely wrong and everything goes to poop and they just maintain their dividend and their profitability that they have now, it's very hard to lose, right? It's one of those bets. It's like, okay, if I win, great, awesome. You know, I'll do pretty well. If I lose, I still win. So that's why I like this company so much, right? And again, it's one of those things that people can do what they want based on their beliefs and what the risk that they're willing to do in this sector. I've already got speculative bets, so it's nice for me to have a company where I can just kind of chill, relax, and sleep comfortably at night and get paid to sit around, right? I see this as a great opportunity, this author says, and so do I. And you can take a look at a lot of these metrics compared to their competition, and these are just awesome, awesome metrics. High operating margin, high return on equity, high return on assets, very low debt, and even if you cyclically adjust, did I put that in here? No. But even if you cyclically adjust this and you say that, you know, we have $70 oil price, and you assume that oil prices are going to go down, even then you can assume that the price that you're paying now is still pretty cheap, if not very cheap. But hey, if you think that there's something I've missed, love to hear the comments below. Thank you guys for hanging out and see you guys soon.